globe to better understand the opportunities in this country. But as Tom said, I'm going to, off that base, if you like, broaden and hopefully share some observations from our experience as we have expanded the business globally. Now, I appreciate that this room is well and truly experienced in doing that because of the nature of the members that you represent and the capital that you've got to deploy both in Australia and around the world. I nonetheless think it's fair to say that the opportunity going ahead, and indeed arguably the responsibility going ahead, is that we will continue to need to pick up the pace of our global expansion. And what I'm going to do is walk through about 5 drivers that, from our perspective, are imperatives that will encourage that continued expansion globally of the portfolios that we collectively run in this room. But I'd also like to start by reinforcing that, notwithstanding our global experience as an Australian superannuation industry sector, according to the APRA stats, about 65 to 70% of the assets that we manage today, i.e. the Australian superannuation system, still sits in Australian capital markets. Australian equity markets, Australian bond markets, Australian property markets, Australian infrastructure markets, and so on and so forth. So according to that aggregate data, roughly only about 30% of our money is invested in global markets. And as I said, I'm going to walk through 5 drivers that I think will potentially hasten that diversification. Why were we asked to present on the observations and learnings? Well as what Tom just briefly alluded to, as many of you would be well aware, we were established about 20 years ago to think and act like the people who established us, solely in the interests of investors. We're also established to provide some competitive tension in what was then a nascent funds management market in Australia, but also to provide some optionality for, in particular, our founding shareholders in Australia. And I think the third reason why we were established is, and Gary Weaven uses this phrase, so I'll obviously accredit it to him rather than plagiarise it, but in essence we're also established to enable the smallest, mainly working Australian at that stage, the opportunity is to invest as if they were the largest, most sophisticated investor. So that were the 3 reasons why we were established. You roll forward to now, those 3 drivers still exist. However, it has to be orientated onto the global stage. We have to provide competitive optionality and tension globally with the global funds management market. We have to continue to act in our investors' interests and access world opportunities, not just Australian opportunities. And we have to continue to give the average Australian investor the opportunity to go and buy Manchester and Stansted Airport because of the collective power of what we've got. So that has driven us at formation. It continues to drive us today, and it's one of the reasons why we are increasingly a global business, because it is in our investors' interests to do so. So today, IFM, in 2006, we had virtually no money invested overseas. We had no clients overseas. We had no staff overseas. Today, of our 53 billion, around about 30% is invested overseas. 25% of our staff sit overseas. We have 147 investors around the world. Half of them are non-Australians. Half are non-Australians. We have investments in Poland, in Germany, in the United Kingdom, in Brazil, in Latin America, of course in the United States, and of course in Australia. So I hope that with that experience we're able to share some useful insights with you today. So let's firstly look from our perspective as to what are the drivers that will prompt us to continue to expand internationally. Before I turn to the first slide, at the risk of, I don't want to embarrass anybody, but what's the proportion of the Australian superannuation industry relative to the Australian stock exchange? What percentage of the assets does the Australian superannuation system represent contrasted to the Australian Stock Exchange? Any guesses? No, you're not allowed. It's 100%. Today in actual fact, the Australian superannuation system is 120% of the ASX. Now I use this it's only one capital market that we've got the opportunity to invest in. Look at the Australian bond market. It's virtually non-existent. The Australian infrastructure market, we really welcome the federal and the state government initiatives, the 15% incentives to bring more infrastructure assets to market. But honestly, to date, the relative activity in Australian infrastructure has been benign. Australian property, we're getting, we're not the experts there, but clearly we have a relatively constrained capital market in property as well. So the broad point here is that with our strong system, but also our growing system, going from 9.25 to 12, hopefully, if the governments continue to support it, with a relatively young demographic, most of the analysis that we've all seen suggests that we will be cash flow positive and relatively substantially so for the next 15 years. We will continue to exacerbate this problem. We will outgrow capital markets. We'll put pricing pressures into the capital markets in Australia. Again, one of our primary expertise is infrastructure. We're still seeing some value, but we're seeing some pretty amazing prices being paid for some things in the Australian infrastructure markets. So the broad point, first and foremost, issue number one for us is we're big, we're getting bigger, and we're outgrowing the domestic markets. That's why IFM went overseas in the first instance, to go and find infrastructure opportunities outside of Australia. And in actual fact, that's probably one of the first insights that I'd like to share. I wasn't there, but Gary and the team in 2006 established offices in New York and London. Then the global financial crisis hit. At a time when many fund managers around the world were pulling offices back, making people redundant, IFM was continuing to invest in globalising and getting investment opportunities to our investors back in Australia. First insight, be patient. Some extraordinary things are going to happen. They're not going to necessarily be positive. Some things may well happen in your business, but if you are going to go overseas, you're going to have to be patient and withstand factors that you will not anticipate. It's all part of the learning. Now, we had a great learning, as did many businesses in 2006-07. We had to endure one of the worst financial upheavals in all time, but we stuck with it, and that has really paid dividends for our investors. So I think patience is clearly a core insight that we'd like to share. Excuse me. The second driver is just the simple issue of diversity. I appreciate that there are very good reasons why we have a domestic bias. We know it well. The Australian imputation system is very advantageous for Australian investors. There are a lot of compelling reasons why we have a 65 to 70% home country bias. However, the generic assertion from us would be that notwithstanding this, there is clearly an opportunity to access. Look at the things we've seen in this country alone, let alone the rest of the world, and yet we've got 7 out of $10 invested in Australia. So there is clearly an opportunity to diversify. Having to perhaps extend and expand on that argument, if you like, this is some work that we did last year, IFM, in conjunction with Macquarie Securities. We have a great love-hate relationship with Macquarie IFM, but we certainly respect their research insights, absolutely. We also work with the University of Singapore and many of our advisors around the globe to try and get an aggregate position as to what we thought the return outlook was locally and globally in various sectors that we're all contemplating and or are exposed to. And there are two key things that for mine come out of this. Happy to go through the detail at some stage with anybody that may well be interested and how we got to these numbers and so on and so forth. But the two key insights for myself and for our team were, one, the red crosses were in the main on the left-hand side of the blue boxes. So the return outlook in the main was less attractive across most of the asset classes than the historic 10-year returns. Observation number one. Observation number two, in the main, not always, that the global opportunity, based on our assessment and the advice that we took with a range of people whose insights we trust, the return outlook globally appeared to be more compelling internationally than locally in Australia. And again, this is not for the sake of this presentation. We did this actually 6 or so months ago, well before this presentation was born. Now, clearly, that suggests that we do need to make sure that if we are looking after our members' best interests, which of course we are, that we're taking advantage of the premiums that, in our view, generally speaking, exist overseas. Now, it's not the sole driver, but one of the drivers there is the Australian superannuation system is getting bigger. So the supply of capital there is clearly has the potential to push prices up in our market. It's as simple as that. And then we've got a whole bunch of other people coming into a relatively constrained market. So you put those two things together, intuitively, you'd think at this point in time, when there's a supply of capital around the world with low interest rate environments, countries like us that are relatively capital constrained are probably going to have some pressures on their pricing. It's not to say things are ready for a fall tomorrow, but generally speaking, we'd say the observations and the opportunities globally are stronger than the opportunities locally. But that's a generalisation, and I appreciate there's many people in the room going, yeah, but, and I largely would accept those without knowing what specifically your buts are. The fourth issue is, in essence, the world is getting older and cannot afford it. Governments have been the traditional financiers of people getting to retirement, and we're seeing it in our country, we're seeing it in many countries around the world. The average age of the population is going up. The people that have generally financed that ageing population are governments, and as I'll show in a minute, those governments are constrained. So there needs to be an opportunity for private capital to fund that need. And you need to therefore match that funding need with investment opportunities, and/or they need to be created globally. So the world is getting older and cannot afford it. Step up the private pension fund market and innovate into markets that might present valuable investment opportunities for clients. The world needs what we've got, like we collectively: private, patient, responsible, long-term capital, in order to enhance the living standards of communities and address that demographic issue globally of ensuring people get to retirement and can afford it, because the traditional providers will not necessarily be in a position where they're funding it. So let's take that one step further into an area that we know better, and that is around infrastructure in particular. We see that, according to the G20, who are meeting in Australia in November, there is something like a $30 trillion gap in the infrastructure funding needs of the G20 nations. 57 trillion needed, 20-something available. There's a 30 trillion gap because the world's infrastructure is not adequate for the demands. In places like America, it's rated D, according to the American Engineers Association. Fly into the airports in America, drive across some of the roads in America, and tell me what your personal experience is. The world needs infrastructure, but you look at America again, and in particular their percentage of debt to GDP, they can't afford to fund it. So the world is looking for ways in which this funding gap can be filled. Again, that presents opportunities for us in Australia and of course around the world. And it's not just governments that can't afford to fund this gap, it's also the traditional financiers in banks. Now that varies again around the world. The Australian banks are pretty strong and are still relatively active in financing infrastructure. But in Europe, where there's Basel III regulations and where there's otherwise balance sheet constraints, banks are less inclined to provide the long-term patient capital to invest in the sectors that, in our sense, will generate superior returns, and our experience will generate superior returns for investors. So as I mentioned, it's one of the 4 priority areas. The 20 richest nations in the world are coming to our country, Sydney, in November. They've got 4 priority areas of all of the things that they can address. 4 priority areas. One of them is how do we fund the infrastructure gap globally? Now, we IFM have been invited to be involved actively in that. It's terrific. Be careful what you wish for. We wanted to make sure that we're participating in those sorts of policy debates globally because it is in our investors' interest to be there and make sure that others aren't setting that agenda and damaging communities or damaging retirement outcomes. So we IFM need to be there on your behalf, and we are being invited to be at a number of those forums. We're very conscious that it can be a black hole getting involved with governments and policymakers. However, we can't afford not to be there. We're not just investing capital, we have to make sure that we're playing a role in the policy frameworks and some of the solutions that are going to be contemplated around this. And one of the things that we're clearly putting forward is this whole social privatisation model. What the New South Wales government did in New South Wales is now being emulated around Australia. The federal government has stepped in and said, here's a 15% incentive to do exactly what the New South Wales government did, privatise the assets, sell it to long-term responsible owners like superannuation funds, and recycle that capital back into the much-needed new infrastructure of the community. A great model. So Australia is now embracing that. Without being too nobilistic about it, why shouldn't the world? Why shouldn't America be privatising the Chicago O'Hare Airport that they've tried to do twice, to recycle the capital back into new things? The same in all of the states of the United States of America. The same in many parts of Europe. How is it that we get the social privatisation model that's been case studied and adopted in New South Wales, benefited our investors, benefited the state government because it's remediated their financial position, and benefited the citizens of New South Wales? Why shouldn't that model be adopted, certainly nationally and indeed internationally? And that's the sort of role that we hope to play in globalising the business on your behalf. A couple of extra stats that I'm not going to run through, but combine those 5 drivers: the outgrowing capital markets, the general need to diversify, the fact that we're getting older, the specific opportunity in infrastructure, and what was the 5th one? Anyway, I've already said it, so I'm not going to summarise it again. It's for you to remember. Those 5 drivers, in our view, are really compelling reasons as to why we should continue the march internationally, not just in our business, but on behalf of your members. So what are the things that we have done and or would suggest that we're all conscious of as we continue to globalise? The first thing is, as I've already alluded to, we need to play a role, without burning all the resources of the business, in ensuring that policy issues are being addressed globally. Think about our collective being represented in global forums in an appropriate way. We've also played a role in building a network around the globe. We hope if anything's going on in the spaces that we're involved in, that we are well and truly aware of it and we're being proactive. The other thing I would say, and I'm sure people haven't missed out on this point otherwise, as well as specifically globalising, there are adjacent areas in Australia that you want to be exposed to. I was really pleased to hear yesterday that Honeywell were talking about 55 airports being built in this country in the next 16 years, because I hope a few of those planes fly into Melbourne Airport and Brisbane Airport and Adelaide Airport and Darwin Airport and Alice Springs Airport and Perth Airport, because you're members of the owners of them. So I hope, so by investing in adjacent industries in Australia, we can take advantage of the global opportunities. So that's one thing that we need to be conscious of. It's not all about diversifying out there because of the opportunities out there. It's thinking about the adjacent industries in our country that will benefit from the phenomenal growth that are happening in different parts of the world. With the best anecdote that I've heard in the last couple of days is being 55 new airports. Wow. On average, 10 million flights per annum. Let's conservatively, a few of them flying into Australia. That must be a few aeronautical landing charges, some car park fees, some retail and all that sort of stuff, which is great for your members and great for the returns of the people that we represent. The other things more broadly that we would encourage, we have been thinking about is, well, as I said, firstly, be patient. Tom mentioned about our exposure into Tokyo. For 3 years, we said we want to expand into Asia. We had a footprint in London and in Berlin and the United States and in Latin America and, of course, in Australia. If we're going to be a true global business, we needed to be in Asia. But the question was where? So one of the things that we did was an enormous amount of research. It took us a few years. We sent teams up, but we did a whole lot of desktop research. We really sought to understand the hard stuff, which is pretty easy to get. You can get advisors, you can go and experience it, you can get an understanding of the technical and the legislative environment, but getting an understanding of the soft stuff is really important. And we chose Japan, for a range of reasons, the hard stuff. It is the second biggest pension fund market in the world. Under the Abe administration, it's opening itself up back to foreign investors. It's been in the doldrums for 15 years, so not a lot of competitors are up there. And frankly, from a cultural perspective, in Japan, the balance of economic and social was very much aligned to how we thought. So it was the hard stuff and the soft stuff. But we took a fair amount of time to do that research, which is difficult to do. You can get it out of textbooks, you can get it out of investment banks, you can get it out of lawyers and so on and so forth, but you also need to understand the soft stuff. In our case, that cultural alignment. We speak a different language, we've got different customs, we hand out business cards in a different way, we sit in different spots in meeting rooms that they do. Because when the samurai warrior comes in, he's going to take all the junior guys before he gets to the senior guy at the back. So where's the senior guy? Oh, we know he's at the back. Now, they don't tell you that. So we had to understand all the hard stuff and the soft stuff to make sure that we were doing the right thing by your investors in taking a footprint into one of the biggest opportunities in the world, Asia. So we've started in Japan and we will gradually and selectively build out from there. There is a specific insight on here that I'd like to share. Well, that's actually not on the slides. And that is, as you expand globally, there is inevitably tax issues, risks, and arbitrages. Make sure those tax arbitrages are going to you and your members and not other players, agents or people that are participating in this system. Let me be more specific. I hope and I imagine most of you are aware of this, but just in case. The MSCI index in Australia is actually based on the most conservative withholding tax jurisdiction in the world, Luxembourg. So what? What that means is that Australian-based investors who do not have that tax system should outperform by somewhere between 30 and 50 basis points. So I hope and believe that all the Australians that are accessing international funds managers, particularly passive ones but also active ones, are getting that tax arbitrage before you pay any active fees. Now, I've got to be fair and say that there's a few people that I've spoken to around the industry, they've gone, what? Can you just run that one past me again? So the first point is, can you please ensure that in expanding globally you understand the tax issues and understand that where there are legitimate opportunities, we're not talking about anything illegitimate, where there are legitimate opportunities, that you and your members are getting it and you're not paying for the outperformance through active fees that has otherwise been driven by a conservative construct of the MSCI index, for example, in this case. So, first suggestion outside of the patient ones that I mentioned a moment ago was to ensure that the tax consequences, for example, accrue to your members, not to anybody else. Same issue on the fees. I was surprised to hear one of the speakers earlier on, but probably not surprised to hear earlier on that, in order to get access to the QFI, which Graham Russell with QF11, we thought was how do you get access to QF11? You actually walk to the airport and you get on the damn thing. But QFII was a regime in Graham travels too much. But he talked about how some managers were charging what in my mind seemed to be a pretty significant premium. So the broader point with that as an anecdotal example is make sure that not just the tax arbitrages but indeed the value for money is being well and truly sought out. Australia is a very fee conscious pension fund system and so we should be. But many of the overseas managers that you might otherwise be engaging with are not necessarily used to that precision, shall we say, of pricing that's demanded from Australian pension funds. And their market practice may well be fees are at this level rather than this level. Don't necessarily accept that just for the sake of it. I know that's hard, and I know you all do that, but the positional power rests with you. You're a very attractive dance partner. The fourth largest pension fund market in the world, growing at a more rapid rate, defined contribution, not defined benefit. Fund managers around the world would fall over themselves to be dancing with you. Let's make sure that that positional power is extracted, not only in terms of the intellectual capital through things like tax, but the positional power through things like fees. I've already mentioned that focusing on culture is important. You've no doubt experienced that up here over the course of the last few days. Delightful people, welcoming people, macroeconomics really very, very interesting and seemingly valuable, but we don't know what we don't know, and that's a cultural issue. So understanding those cultural attributes is really hard to define specifically what you mean by that, but take your time, be patient, and make sure that if you're partnering with somebody, they either know about it or you know about it. And in our experience, we've integrated and exported. So when we've established Tokyo, we sent Eddie's son. Eddie's 6'2" for those that don't know him. He's got a bald head and he stands out in Tokyo. But it was really important from our perspective. We exported our knowledge and indeed our culture. And then we employed Shoda-san, a lovely, experienced Japanese fellow that understands the Japanese markets. A great combination of the IFM DNA and the Japanese DNA, respectfully integrating so as the hard stuff and the soft stuff is well understood. The net outcome should be a better outcome for our investors as a result. Some other things to be mindful of as we all expand globally. IFM in the first instance, for what it's worth, again, pre my time, not being critical of it at all, but we originally went with third-party distributors. Now, my strong view is ultimately, if you're making a commitment overseas, you're going to be there in 20 years' time. It's not an experiment that you might pull back on from in a little while, generally speaking. If that's the case, start with the end in mind. And in starting with the end in mind, you've got to have a reputation and a brand that you're proud of, that is always being represented by the appropriate people in the local markets. And that's best done, frankly, if you control it. So whilst partnerships are going to be important, I would always encourage us to be a fairly dominant player in that, because with the long-term end in mind, your position and your brand is going to be critical in your position in that market, and you need to control it. Definitely say no. It can be really seductive walking around the world. It's great fun. We've got great jobs, haven't we? You walk around the world and you can get seduced. In a metaphoric way, by the attractiveness of some of the opportunities. And it's really important that in your guts, you're really, well, not only in your guts, but otherwise, you're really clear on your no-go zones. And one thing that IFM has done, I hope and believe, and we're really disciplined about, is we're very clear on who we won't deal with, the fees and the agency commissions, clearly, that we won't tolerate, the cultures that we won't stand for, the social impact issues that we will not be involved in, and so on and so forth. And even though they might present a wonderful opportunity at the headline level, returns or funds under management, we have and will continue to say no. But that discipline as to where and how you're going to say no needs to be really thought out at the outset, before you walk into the new country and potentially get seduced by the opportunity that's right in front of you. Get clear on what your no-go zones are in the first instance and be really disciplined about the application of those no-go zones. And finally, the operational complexity. The world is always awake. We've got offices in London, in the United States, and of course in Australia in the Southern Hemisphere. There's always somewhere awake doing business. And that brings operational complexity in the literal sense. It also brings regulatory complexity. So in dealing in the United States, we've got one country, one anthem, one currency, but 50 different states. And 50 different sets of regulatory obligations. So in doing business in the United States, we've got people down in California doing ethics exams and people over in Virginia doing other exams, because that's the requirement of Virginia versus California versus whatever else. So be prepared for that operational complexity, certainly from a legal and regulatory perspective, and the generic one of operationally. And also, you know, basic things, somebody mentioned in the earlier session, the language. Open up in Japan, put an English website up in Japan. As useful as, you know, some of you got phrases about that, and one of my dad taught me a good phrase about that, but I probably won't share that with you, but useful as, I don't know, yeah, whatever. So they're basic things, really basic things. However, you've got to be prepared for it, because if you mess that first exposure up in a foreign country, then people will clearly be questioning your long-term commitment to the country. So the operational complexity is also a key thing to be focused on. So as my clock ticks down, it's a very big clock up the front here, I wanted to say thank you, Tom, for the opportunity to share some of our experiences. The drivers are compelling. We as an industry have done a great job. We have a fair exposure to non-Australian markets. However, at 65 to 70%, and with some of the drivers, the 5 drivers that we've talked about here, I believe that there is certainly an opportunity and arguably a responsibility for us collectively to continue to expand our global footprint, to take advantage of the opportunities that are out there, to diversify our current portfolios, to grab hold of those tax and other opportunities as well as those compelling investment opportunities, and in so doing to deliver the superior returns to the people whose money we represent. We've had I think a fair degree of success in doing so, and hopefully you have gained some insights as to how we've gone about getting some of that success, and we hope that that will help you as you continue to expand your global footprint. So with that, I'll shut up and either ask